everyone, and welcome to today's presentation on the all-in-one loan. I do want to go over just a few items before we get completely underway. The first is you may have noticed you entered this meeting in mute-only mode, but that doesn't mean I don't want to hear from you. In fact, I highly encourage dialogue on this product. So if at any time you see anything on the screen or you hear something I say that causes a question, go ahead and type that into the Q&A section or the chat feature of your control panel. Now, it doesn't matter to me which one you use. From my perspective, both are the exact same. Just keep in mind that I am the presenter and moderator, so I unfortunately cannot answer the questions that you ask in live real time, but we will have ample opportunity at the end of the call to go over any questions that you may have. The second item is if you are a guest of a loan officer, you're going to be receiving a follow-up email from me. That email is going to contain a recorded link to this presentation so that you can replay it at your leisure or easily share with friends and family. Your loan officer is going to be CC'd on that email, so if you have any questions, you'll have the correct people on that email, I should say, that you can reach out to. So without any further delay, let's go ahead and get started because we do have a lot of information to cover. Now, if you've never been on a call before with me in the past, I would like to not only welcome you to today's call, but I would like to introduce myself. My name is Erin Wood, and I was part of the team that initially launched this product back in 2005. So I have a unique experience and perspective on this product. I've had plenty of successes and lots of lessons learned. So your loan officers know that they can lean on me and my team to ask any questions and help structure any scenarios that you may have. So they have a full team behind them ready to help answer any questions or help structure any scenarios. Now, before I get into talking about the all-in-one loan to any degree, I think it's important that we all start on the same page as it relates to certain bits of information in the mortgage industry. And I go over this not because I want to bore you by any means. I actually want to make this as exciting as possible. But from a consumer perspective, I think it's important to understand some context as to why we brought this product to market in the first place, as well as review some of the problems in today's financing that this product solves for that as consumers, we just might not even realize is a problem to begin with. So if we take a look at the U.S. as a whole, 62% of Americans have a mortgage on their home. That is a lot of people. We are in good company. But the unfortunate thing is, collectively as a whole, we've already exceeded $12 trillion worth of mortgage debt in the U.S. In fact, we're around that $12.5 trillion mark. Now, it's all relative. To some folks, $12.5 trillion might not seem like very much, and to others, it might seem like a huge amount. So let's add some contrast to that for a second. Let's talk about the student loan debt. And I bring up the student loan debt because we hear about it often. There's a lot of people trying to solve for it. And in some circles, it's actually labeled a national crisis. So we have a national crisis of the $1.5 trillion student loan debt, yet when it comes to the over $12 trillion worth of mortgage debt we're in, there's absolutely nobody talking about how we as consumers can get out from underneath that debt. One of the main components is how we repay mortgages today in the U.S. In fact, we repay mortgages via the amortized repayment schedule. That's the method that we use, and that's been in place since 1938, and it hasn't changed since. Now, as a consumer, that should be shocking to you. Because if you think about it, we live in 2022. 1938 was almost 100 years ago. We're shy of 20 years of it being 100 years ago. But it's shocking because we live in a country that prides itself on technology, advancement, innovation, and progression. But when it comes to repaying the largest debt we're likely to take on as adults, we're still using a method that was introduced in the 1930s. Begs the question, why? Why hasn't that innovated? Well, because it's a reliably profitable way for banks to make money. And as consumers, we don't put too much thought into how we repay a mortgage. Really, what we're concerned with as consumers is that very low interest rate and that very low monthly payment. And if we can get low upfront costs, it's an even better deal. So as consumers, we've bought into the biggest mortgage myth that's out there. And that myth is if you have a low interest rate and you have a low monthly payment, then gosh darn it, you must be getting a great deal, right? Because as consumers, that's what we think. Now, if you take a look at our behavior as consumers in the U.S. and we look at it as it relates to how we repay mortgages, it's actually pretty eye-opening. And I say that because statistically speaking in the U.S., every 5 to 7 years, as consumers, we refinance or recycle our debt. every 5 to 7 years. And some of us do it at a more frequent basis than that because we chase interest rates. So let's take a look at how we repay a mortgage, and let's take a look at our consumer behavior together. So what you're seeing on the screen, this graph represents a 30-year fixed rate mortgage. And every column is representative of a year in that 30-year fix. Go ahead and count back 5 to 7 columns, which represents the amount of time that we are in our mortgages on average before we refinance. Now, in that amount of time, how much interest was paid versus principal balance reduced? I can begin to see why this is a reliably profitable way for banks to make money. Because in reality, we're paying 5, 6, 7, 8, 9 times the amount in interest than we're actually having applied towards our debt. And every time we refinance, we're just starting this back at square one. So again, low interest rates don't actually come with low interest cost. The two are not synonymous with each other. And if there's anything that you take away from today's call, I hope it's this. Low interest rates don't equal low interest cost. Not when you factor in how we repay a mortgage, and not when you factor in our behavior as consumers. Now, as if this wasn't bad enough, let's add a little bit of insult to injury. And I say that because if we wanted to repay our mortgages at all and in any amount, the bank will generally not turn our money away. We're, in essence, allowed to prepay on our mortgages. But as consumers, we don't. Statistically speaking, we do not prepay on our mortgages. And we don't because 30-year fixed rate mortgages are closed-ended instruments. And by that, I mean, if you decided you wanted to prepay at all, you can. The bank's generally not going to turn your money away. But if you ever needed to reaccess those additional dollars you're paying into your mortgage, you cannot easily get them back, which is why, as Americans, we don't prepay on our mortgages. We don't want to part with money we might need. So a 30-year fixed rate mortgage, although it was helpful for folks to in the 1930s with the Depression, we're in 2022. And there should be a better way for us as consumers to borrow money and not have to pay exponential amounts of interest cost. But let's talk about the financial impact we experience because of the amortized repayment schedule. In fact, the financial impact it has, it pretty much eliminates a lot of the benefit we go into owning a home for in the first place. And if you were to boil down the two main reasons why we as consumers purchase property, usually it's one of these two. Either you're purchasing property for shelter or you're purchasing property for investment. And oftentimes those two are going to overlap. Now, if I was to purchase a home for $450,000, when it's all said and done, I'm going to ultimately have ended up paying over $646,000 in total payments. That's principal and interest. But let me break this down so you can see where I'm coming from with these figures. For that $450,000 purchase, let's just say that I come into the transaction with $50,000 of my own dollars. That's going to be my contribution into owning my home. That means I need to finance $400,000 of it. And if I got a 30-year fixed rate mortgage at 3.5%, which by today's standards is really good, I'm going to ultimately end up paying over $246,000 in interest alone. So I have to pay the bank back over half the amount that I wanted to borrow just in interest cost. But let me break this down so you can see this a little bit clearer. The problem I have with breaking down the interest cost I'm going to pay in relation to what I'm going to borrow is that it's in dollar figures I cannot relate to. I cannot relate to $246,000. I've just never held that much cash in my hand before. So as a consumer, I have to break that down into a dollar figure that I can relate to. And you can use the hundreds of dollars if that works best for you. For me, I like to use the tens of dollars because I've held a $10 bill in my hand before multiple times in my life. So in this loan, if I break it down to the tens of dollars, for every $10 I borrowed, I had to pay back $6.17 in interest. Usually they'll round that up to the nearest 10 cent, but technically speaking, for every $10 I borrow, I have to pay back $16.17 because I also have to pay back the amount that I borrowed. That ultimately becomes a 45% increase in the purchase price of my home. Now, for those of you on today's call that have purchased properties in the past, how many of you factored in the interest costs you were going to have to pay when you went to shop for the budget of your home? Chances are you never even considered it, although that is an absolute real cost that we have to pay. And that's a 45% increase in that budget that you shopped for. And this is happening with that perceived good deal. that really low, warm, fuzzy, secured fixed interest rate. Again, this fixed interest rate, that's low, is not coming with low interest cost. The two are just not synonymous with each other. You could make the argument that my home is going to appreciate, so I will, in essence, recoup those costs, and I use that term very lightly. And to an extent, I'll agree with you. My home is going to appreciate. And if I use that conservative 3% model, my home is going to be worth over $1 million at the end of that 30 years. So for an initial $50,000 investment, that's not bad. But because of the financing option I chose, it actually cost me 23% of the cumulative wealth that I could have had if I would have chosen a different financing option. Now, mortgages and savings. Being a consumer in America can be very confusing at times. Now, for the majority of Americans out there, and that includes you and I, the largest asset we're likely to receive in life is the income dollars that we earn. We never treat it that way. In fact, the income dollars that we earn, if your salary, you know exactly what that is every paycheck. If you have fluctuating income, you at least have an idea of the parameters of what your take-home pay is going to be. But for the majority of us, what we take home, for the most part, is already spoken for. We have our lifestyles. We have our living expenses. We have our future selves that we have to think about. It is no secret America is vastly underfunded for retirement. College costs continue to rise, hence the student loan debt. A lot of us have aging parents that we have to think about what's next in store for them. So we have a lot of things as consumers in America that are vying for our income dollars. On the flip side of that, as a consumer in America, we are inundated all day long with ways to save money. And consider some of the advertisements that you see on TV or the internet. Change your car insurance provider and save a few bucks. Change your cell phone provider, save a few bucks. Cut out cable, stream your services, and save a few bucks. And all of those are well and good. Believe me, I am a proponent of saving money. And as a consumer, those are the areas I have control over. But changing my car insurance provider isn't going to allow me to all of a sudden retire comfortably and early. Changing my cell phone provider isn't going to all of a sudden allow me to send my kids to college. Those are just some of the areas that as a consumer I do have control over. When it comes to the amount of mortgage interest that we pay, we've never had control over that in the past. That's something that's dictated to us by the bank via that amortized repayment schedule. And that's really where the all-in-one loan comes in. Now, I really want to stress that the all-in-one loan is not how your parents mortgaged. It's not how your grandparents mortgaged. It's a new and innovative way for you as a consumer to actually start putting your money to work for you versus letting it sit idly and working for the bank. Now, it doesn't matter if you're a current homeowner or if you're in the market to purchase a home. It doesn't matter what side of that fence you're on. Every single all-in-one loan customer are going to experience things with their financing that traditional financing was never intended for you to experience. Most noticeably, it's going to be a reduction in principal balance, and that will happen 2 to 4 times faster than in a traditional mortgage because it's principal paid first. A mathematical byproduct of paying your principal first is a reduction in interest cost month after month. You have the flexibility of accessing your equity dollars to use at your discretion if and when you choose without refinancing. And the beautiful part about this is it all happens without you changing your budget, your lifestyle, or your spending habits. In fact, you're going to hear me repeat that several times on today's call, probably at a very annoying level. But I do that because I want to hit that point home. The easiest way to set someone up for success is to eliminate or reduce the amount of changes they have to make. And when it comes to the all-in-one, we don't want you to change a single thing. Whatever it is you're doing today, do tomorrow in the all-in-one loan. So what makes it different? Why does it stand out from any other mortgage product that you've heard about or even been in the past? Well, traditional mortgages pay the balance down very slowly, and the majority of your payments that you make are going towards interest, not reducing the balance. And by going to interest first and not reducing the balance, that allows those interest costs to be collected at a higher rate. So a traditional mortgage, it delays that pay down very slowly so that interest costs, even with a low rate, can continue to be collected at a high amount. The all-in-one loan flips that around completely. We say you pay your principal balance first, we'll settle up on interest the following month. And I'm going to get to that calculation in just a few moments. But the all-in-one loan is different than traditional financing in how we apply that payment. But what is the all-in-one loan? How do I describe it? Well, the all-in-one loan is absolutely an innovative way of making your money work for you and not the bank. And we do that by combining two financial instruments. We combine the home financing and personal banking together into one fluid account. So the two instruments are actually starting to speak to each other. And I know that might sound out of left field and very strange. How in the heck does it ever make sense that my checking accounts speak to my mortgage? And moreover, how am I able to save an interest by having the two communicate? Well, let's break this down. I'm going to ask you a few questions, and on the surface, they're going to sound very absurd. I get that. But just follow along, have an open mind, answer these questions for yourself in your mind, and let's see if we can follow along and make this make a little bit more sense. So every week, every other week, twice a month, or monthly, whatever your pay schedule is, what is it that you're doing with your paycheck? Well, we're not burying it in the backyard in a jar, hopefully, or putting them under our mattresses. Typically, we deposit our paychecks into our checking accounts, don't we? And oftentimes, we never even get a physical check anymore. It's just electronically deposited from our employer into our checking accounts. Okay, so we've established that we put our paychecks into our checking account. Our checking accounts are the financial instrument that we use to manage the largest asset we receive in life, which is our income. But my follow-up question to that is this. Why are you using a checking account in the first place? Again, I know it sounds odd. We obviously use checking accounts because they're safe, they're secure, and they're easily accessible. Any other reason that you're going to use a checking account, and it typically falls into one of those three categories. Now, in the all-in-one loan, your money stays safe, it stays secure, and it is 100% completely accessible to you via the methods you are already proficient at using. In fact, every all-in-one account comes with a Visa card that's also backed by the star logo, so you can use it as at an ATM machine anywhere the star logo is accepted. You can use it as a point-of-sale card anywhere Visa is accepted. You can order personal checks. You can sign up for online bill pay. They even have a mobile banking app where you can take a picture of your check on your phone and deposit it into your account. There's fraud protection features, there's auto alerts, you can add users. So the account is going to absolutely look and feel and function exactly like a checking account does today. Only now we've put that mechanism in place to put your money to work for you. But what do I mean by that? Well, every single time you make a deposit into the all-in-one account, it doesn't matter the amount and it doesn't matter the frequency. When you make a deposit into the all-in-one account, if you have standard AIO, at 12 a.m., that deposit is going to sweep to the mortgage side of the account. It's going to reduce the balance by the amount that you deposited. Now, Texas Homestead AIO, there is a slight variance to that in that you, instead of it being a manual sweep, you actually push the funds. And we'll get into more of that in a moment. But at this point, I will usually have a customer that will stop me and say, okay, Erin, hold on a second. I get that if I deposit my paycheck into the all-in-one account at 12 a.m. for standard AIO, that deposit is going to sweep into my mortgage and reduce the balance by the amount that I deposited, which is my paycheck. I understand that. But I just can't see myself devoting my entire paycheck to my mortgage because I've got groceries to buy. I have bills to pay. I have activities I need to put my kids into. So although this sounds good, I just can't see myself doing that. And it's at that point that I agree with that customer 100% wholeheartedly. Yes, by all means, buy those groceries, pay those bills, put your kids in the activities. Whatever it is you're doing with your money today, do tomorrow in the all-in-one. So inevitably, when money is spent out of the account, the balance will go up by the amount that was withdrawn. What this slide beautifully illustrates is that until you spent that money, it's staying in your account, keeping your balance low, which is going to, in turn, keep your interest costs low. And that leads me to my next point. How are we calculating interest on this loan in the first place? Well, with the all-in-one loan, there is no amortized repayment schedule. We are not going to predetermine a single cent in interest that you owe. We're just not. Instead, we're going to take a daily calculation based on that unpaid principal balance. So you make a deposit in standard AIO at 12 a.m. that will sweep to the mortgage and reduce the balance by the amount that you deposited. If it's Texas Homestead AIO, you get to decide how much of that you want to push to the line of credit to reduce the balance by. Once that push or that sweep happens, on the lower amount, we're going to take a calculation of the interest for that day. So we take the new lower balance, We times it by the interest rate, and then we divide by 365, and that becomes that day's interest cost. Now, we don't charge it daily, we just calculate it daily. Once the month is completely over, we're going to add up all of those daily calculations, and that becomes the interest portion that, if you have standard AIO, will be automatically deducted out of the account on the 21st of the following month. Or if it's Texas Homestead, that will be the interest payment that becomes due on the 21st of the following month. So whether it's standard AIO or Texas Homestead, your interest costs for the month are always going to be due or collected in arrears. There is no other lender in America today that will take their interest second. They all take it first. And in the all-in-one loan, we never change how we calculate or collect the interest that's due. Now, what's really important to remember from a consumer perspective is that we've separated the principal payment from the interest payment. It's two separate events. In a traditional mortgage, they happen together at once. Once a month, we send in a payment. It gets split between interest and principal. We move on to the next month, send in another payment. That's split between interest and principal, and we move on and on. But in the all-in-one loan, every single deposit that you make in standard AIO or every push to the line of credit in Texas Homestead AIO is a direct reduction in principal balance. That's beneficial because on that lower balance is what we're calculating the interest on. So you as a consumer actually have the ability to put your money to work for you, saving you an interest while you wait to spend it. Now, I'm going to briefly go through a mathematical example because I think it helps from a visual perspective to see how this account would work in a month-to-month fashion. Now, we are going to be demonstrating standard AIO, and I'm going to be using the example from earlier, that $400,000 30-year fixed-rate mortgage at 3.5% versus the all-in-one, a $400,000 mortgage, 30-year open-ended. And I'm going to use an interest rate that's not current. So before anyone gets upset, 5.188 is not a current rate for the AIO. We do have some in the high fours, depending on the term, and it can go up to the mid fives. So this is kind of an in between, but 5.188 is what we're using. Now, obviously, I have it higher than the comparison loan at 3.5%. That's done with intention. I want to bust that myth. It isn't about the interest rate. It is about the size of the debt the rate is calculated on. So even if you have a higher interest rate, the interest cost could be less because of the balance by which it's being calculated off of. So that's the two examples, or the one example we're going to go through. I'm going to use a borrower and a co-borrower that have salary and expenses that leave them with about 13% on average left over at the end of each month. And that definitely fluctuates. My two borrowers have two different pay schedules. So in the example we're about to see, I have condensed it so that they get paid once a month and on the same day. But in reality, they do have different pay scales. But again, I wanted to make this as easy as possible for everybody to see how it visually works. So we start off with that $400,000 balance. My borrowers deposit their paychecks into the account at 12 a.m. because it's a standard AIO. That's swept to the mortgage side of the account, and it reduced the balance by the amount that they deposited. What they deposited remains completely liquid to be used and accessed however they wish using the methods they're already proficient at using. So again, ATM cards backed by Visa and the star logo, personal checks, bill pay, linked accounts for ACH transfers. So again, however you're used to using your money, you can still use your money in that fashion with the all-in-one, which is exactly what my customers have done. They spent their money periodically throughout the month, so it slowly raised the balance back up. But they ended month one with a lower balance than they started with for two reasons. Number one, their previous mortgage payment that they didn't have to make anymore, but they left it deposited in their account. They're still budgeting for it, as well as their positive cash flow. So those two amounts are staying in the account all month long, keeping the balance low, keeping the interest low. So they end month one with a lower balance than they started with. We get to month two and the process repeats. The deposit goes in, the balance goes down, spending is going to make it go back up. Now in month two, we've deducted the interest cost that was calculated from month one. For Texas Homestead, on the 21st is when it would be due, and that would be a physical payment, whereas standard AIO, it's just taken out of the line, and that came to $1,473. But even still, they're going to end month two with a lower balance than they started with that month because they have their positive cash flow and previous mortgage payment from month one still present. Then they have month two's positive cash flow and the surplus left over from what they were budgeting. They're budgeting $17.96. That first interest came to $14.73, so there's some left over there. And that's all starting to add up and compound as we go along. Well, we get to month three and the process repeats. The deposit goes in, the balance goes down, spending is going to make it go back up. But I'd like to bring your attention to the interest payment for month two. That came to $14.65. In month one, it was $14.73. Now, as consumers, what is the number one reason why we chase interest rates? We want a lower payment, right? We equate that with getting a good deal. And that happens automatically month after month in the all-in-one loan. Why? Interest is being calculated on a continually lowering balance. And if you looked at these customers after 3 months or 90 days, however you want to look at it, my customers have already got a better equity position of over $6,800. And they didn't have to do anything with their budget, lifestyle, or spending habits to achieve it. That's just naturally how the product works. Whereas their counterparts in the conventional mortgage, they only have an equity position of about maybe $2,895. So substantially lower than what their counterparts in the all-in-one were able to achieve. Now, you could make the argument 100% that the longer you're in the loan, the more you're going to save. And I wouldn't argue with you on that at all. In fact, I would agree with you 100%. But let's take a look at the years to pay off. It took my conventional customers 30 years, whereas my all-in-one customers, it took them about 12.6 years. Now, 12.6 years sounds good, doesn't it? But I bet it's not resonating very well, is it? And I wouldn't expect it to, because as consumers, we don't think about our money in terms of years. We think about our money in terms of payments. So if these customers were sitting in front of me, this is exactly how I would position it. Would you prefer 360 payments of $17.96? Or would you prefer 148 payments? What sounds like the better deal? What sounds like the better value? Now, when we take a look at the total amount repaid, principal plus interest, my customers in the conventional mortgage, they paid back over $646,000. That's principal and interest. In fact, their interest as a percentage of principal was 62%. But what the heck does that mean? Let's break that down to the tens of dollars. For every $10 borrowed in that loan, they had to pay back $6.20 in interest. Whereas in the all-in-one loan, sure, they paid back over $525,000, but their interest as a percentage of principal was only 31%, or $3.10 for every $10 borrowed. Now, the conventional mortgage, that started off at the 3.5% interest rate. That was the warm and fuzzy good deal. For that 30-year fixed rate mortgage to save these customers the exact same amount in interest, forget about time, forget about accessibility to equity, just in interest cost savings alone, that 30-year fix would have to be locked in at 1.912%. Now, when you take a look at the savings or the wealth accumulation difference, just depending on what side of the fence you're on with that, my customers in the all-in-one loan ultimately saved over $120,000 in interest cost, not to mention over 17 years of not having to pay a mortgage. Now, I would almost venture to guess that you would be hard-pressed to find any family or household in the U.S. today that wouldn't think $120,000 is life-changing, because it absolutely is. That's kids going to college. That's helping our parents as they get older. That's building our property portfolio or just investing into the family versus giving that to the bank in interest cost. Now, if you were to ask me what the difference was between traditional mortgages and the all-in-one loan, in my opinion, and you don't have to agree with me, but in my opinion, I believe it's 100% centered around how the payments are applied. Because in a traditional mortgage, we have a very rigid, amortized repayment schedule. The bank, well in advance of the loan closing, knows exactly what our monthly payment is, which is good for them because then they know how much they can take in interest and how much they'll allow us to apply to the principal balance. Oh, and by the way, anything extra you decide to pay into it, you are not going to easily get back. Whereas in the all-in-one loan, we take a completely different approach. We say, go ahead and leverage the largest asset you're likely to receive in life, which is the income dollars that you earn. Put that towards the largest debt you're likely to have, which is your mortgage. Control your payoff timing, save money and interest, and have that flexibility of reaccessing those equity dollars without having to refinance at your discretion. So it's the ultimate win-win-win for the customer at that point. Now, in this product, there's 4 ways you get to save that you don't get to take advantage of in a traditional mortgage and checking account setup. And the first way you save is by putting your money to work for you. When we deposit money into our checking accounts, and while it's waiting to be spent or not, as it's sitting there, it is 100% being leveraged by the bank for their own purposes. And generally, that's to build their own wealth and bottom line. So they're using our money to their benefit. And oftentimes, we pay to have checking accounts there. So we don't get that benefit, the banks take it. And in the all-in-one loan, we say, don't let the banks take advantage of that. You've worked hard for your money. Put your money to work for you, not the bank. Every time that's deposited into the all-in-one, it reduces the principal balance by the amount that you deposited. The second way that you save money is with the money you're going to spend anyway. In fact, I invite you to ask yourself these 3 questions. Do you buy all of the food that you need for the month in one day? Do you buy all the gas you need for the month in one day? Are all your bills due on the exact same day? Chances are you said no to all 3 of those questions. That means that we have money sitting in our checking account that's waiting to be spent on one thing or another. Regardless of what that amount is, it's sitting there waiting to be spent. And as it's sitting there, it's 100% benefiting the banks. In the all-in-one loan, what we suggest is let that sit against the largest debt you likely have, which is your mortgage, and let that money work for you to keep the balance low, which is going to in turn keep your interest costs low. The third way you save is by not changing your spending habits, and that actually includes your current mortgage payment. In fact, in 2005, when we first launched this product, I used to tell customers they could keep their current mortgage payment with this loan. That was my way of conveying to them at the time that I didn't want them to change their budget, their lifestyle, or their spending habits. In fact, if you think about it this way, in that $400,000 30-year fixed-rate mortgage at 3.5%, I have a principal and interest payment each month of $1,796. That $1,796 is derived from my income dollars. Those income dollars get deposited into my checking account. I write out a check or set up a bill pay, and that goes to the bank, and they split that between interest and principal, and I move on to the next month. In the all-in-one loan, that $1,796 is still being derived from my income dollars. That absolutely did not change. But instead of depositing that into my checking account, I'm now depositing that into my all-in-one account. And instead of having that $1,796 sent to the bank and split between interest and principal, I get to keep that $1,796 against my principal balance all month long, keeping it low, keeping the interest costs low, on top of all of the other funds that I have in the account. Speaking of which, the 4th item, my positive cash flow, the money that I wasn't necessarily going to spend in the first place. That's going to sit in the account alongside my previous mortgage payment in the form of home equity dollars, which means they're going to remain completely liquid for me to use and access if I ever need to. But until I do, it's going to stay in the account, and it's going to keep the balance low, which is going to keep my interest costs low. Now let's talk about how this line of credit is structured. With the standard AIO, there is no balloon payment, there is no forward amortizing repayment schedule. So those are things that we do not have to deal with, which is good because in traditional financing products that have balloon payments and amortized repayment schedules, we typically as consumers don't handle them very well. We end up refinancing anyway, and it changes our trajectory of our financial goals. So we don't have to deal with that. But how are we able to achieve a payoff at the end of 30 years if we're not going to require any sort of rigid, structured repayment? We do that by reducing the available credit line after year 10. So year 11, month 1, we're going to start to reduce that available credit line by 1/240, or the loan amount divided by 240, because there's 240 months in 20 years, so however you want to mathematically arrive at that. Every now and then I'll get a customer that'll stop me here and say, okay, Erin, well, hold on a second. Does this mean that in year 11, month 1, I have to start making an extra deposit each month? And my answer is always the same. Absolutely not. In fact, by the time it gets to the point where that credit limit starts to reduce, customers don't really feel that like a pinch where they have to hurry up and make a deposit or a transfer. It's the exact opposite, actually. The average consumer time in the all-in-one loan before they reach payoff is 8 to 12 years. 8 to 12 years is the average for payoff. We have some folks that have been in the loan for 2 to 3 years before they pay off, and some folks that have been in the loan since 2005. So they're coming up on their 17-year anniversary. They're already in the credit limit reduction phase, but they continue to stay in the account because of the flexibility and optionality it offers. And that's exactly what you're seeing on the screen. The customer got into the loan and they didn't make any changes to budget, lifestyle, or spending habits, so they're automatically seeing a pretty rapid reduction in their principal balance. They pull money out along the way for different items as they needed to without refinancing, and then they get to the point where their mortgage balance is zero. And once that happens, as the customer, you have two choices. You can either close out the account and be mortgage-free, or you can continue to pay the $60 annual fee that's waived the first year and have access to the available equity dollars that are there, which is what these customers did. Once they reached payoff, they decided to keep the line open and access those available funds later on down the road. There is no other mortgage product that's this flexible. Now, if you are in the great state of Texas and you have a primary residence, that's referenced as Texas Homestead, and the line of credit is slightly different than standard AIO, although it is completely still effective. There is no balloon payment, so we don't have to worry about that. But with the major difference of the Texas Homestead AIO versus standard AIO is instead of it being a 30-year draw, it's a 25-year draw. You'll notice in the last 5 years, we do have an amortized repayment schedule that may be applicable depending on what the balance is at that point in time. We are still using the same reduction in credit line after year 10. So year 11, month 1, that credit line is going to start to reduce by 1/240. So we still keep that intact. However, once you get to month 300, whatever the rate is at month 300 is the rate that it'll be for the remaining 5 years. To align with the Texas Homestead A6 laws, we have to have that last 5 years as a fixed option. So whatever the balance is in that last 5 years, that will be amortized into a 5-year repayment so that at the end of the 360-month term, we have an eventual payoff. But I get the question often, well, what does that mean the last 5 years? Well, if you're an average AIO consumer, chances are you are going to be paid off before that 5 years happens, whether you keep the account open or not. It's just very often that balance will be low to zero by the time you get to that fixed portion. And if you have a zero balance in month 300, there's no interest that can be calculated on a zero balance. So keep that in mind as well. So even with the Texas Homestead, our customers are going to see a payoff in that same average 8 to 12 years. Now, when it comes to accessing the account and who services it, we've partnered with Merchants Bank of Indiana and North Point Bank. They are our partners on this loan, and they take amazingly good care of our all-in-one customers. In fact, they each have a dedicated customer service line, so if you have questions, you're not going to have anxiety about describing this product you're in to a customer service agent. You're going to be reaching a team that is already well-versed on what this product is and will be able to help get you pointed in the right direction. About 3 days after the loan funds, you're going to receive your congratulations letter that has a 6-page FAQ document attached, so you know how to customize your account when you get access to it. About 30 to 45 days after that, you are going to receive your Visa card and transfer letter. That's your indication that the account has been set up in the post-closing process, and it's ready for you to access and customize with direct deposit, linking external accounts, adding users, ordering checks, and that sort of thing. So that happens about 30 to 45 days after the loan closes. When it comes to the rates and the rate term options, this usually is a hot topic. And I say that it's a hot topic because as consumers, if we're being honest with ourselves, what are the first 2 questions we ever ask any industry professional when the topic of mortgage financing comes up? What's my rate and what's my payment, right? Because as consumers, we've been conditioned that the answer to those 2 questions will determine whether or not we're getting a good deal. What is really important to remember with the all-in-one loan is that it is rate tolerant. That means it's going to perform for you in a high rate environment, and it's going to perform for you in a low rate environment. Why? Interest rate matters least. Now, I'm not saying it doesn't matter. Obviously it does. But mathematically speaking and emotionally speaking, interest rate matters least in a principal paid first product. What matters most is you as the customer putting your money to work for you. In fact, using your own money is a better financial hedge than any low interest rate that you can get. And in the all-in-one loan, you have 3 rate term options you can choose from. We have the 1-month adjustable, which to this date is the most popular option. We also have a 3-year fixed as well as a 5-year fixed option. Because this is an adjustable, we do use the 1-year CMT as the index, and we do use it in a monthly fashion. You have margin options that range from 2.5% to 4% depending on the rate term and the occupancy, so you'll want to talk with your loan officer about what margin is going to be applicable to your scenario. We don't let the rate adjust indefinitely. In fact, we have a lifetime cap of 6% above your initial rate. What that means is whatever your initial rate is to start off, it can only go higher than 6% above that. They can't go higher. So that is our cap. We also have floor rates, and that will range depending on the occupancy, and that means that your rate will never be lower than that. But keep in mind that it's your margin that stays consistent. It's the index that adjusts. Now, for our Texas Homestead folks, you still have the same rate term options. That didn't change. You still get the 1-month adjustable, the 3-year fixed, and the 5-year fixed. But unlike standard AIO, you are going to have that 5-year fixed period at the very end of the term, if you're even in the loan that long. We still use the same index, the 1-year CMT, on our Texas Homestead folks. And because it's a primary residence, your margin options are 2.5% to 3.75%. We still have the same 6% lifetime cap, and your floor rate would be 3.75%. Now, that's a lot of talk about rates and indexes and margins and all of that, so please continue this piece of the conversation with your loan officer as it applies to your scenario. Now, I am often asked who this product is right for, and I genuinely believe the answer to this question changes depending on who you pose this question to. If you're going to ask me, I say every single American should at least know that they have access to this option. But that doesn't mean that I think this is the right loan for every American. Not at all. If money burns a hole in your pocket or you're not a good steward of your money, this isn't the loan for you. There are plenty of other options out there your loan officer can help you get into, but this isn't the one that I'd necessarily recommend. However, if you are a good steward of your money, if you live within your means and you don't spend more than you earn, this is absolutely a product that I would encourage you to take a deeper look at. Folks that have fluctuating income absolutely love this product because of that flexibility and optionality. In fact, if you take into consideration the ebbs and flows of life, this product is going to allow you to manage those with a lot more grace and flexibility. When you consider how it works with the deposits and the withdrawals and how your money is being put to work for you, let's just say life happens, whatever that ends up being, whether that's job loss, a medical emergency, the car breaking down, the roof starting to leak, any number of those things that just throws everything into kind of a tailspin. As long as there's enough available equity dollars there to absorb the interest costs that were calculated from the previous month in standard AIO, you do not need to make a deposit. Maybe you don't make a deposit for a few months or years. Everybody's case is different. But I can't tell you how often we hear from customers around the country writing in, thanking us for having this product available because the inevitable life happened and they had this product to help them get through those life instances. Now, one of the most special things about this product is that it becomes as individualistic as the family and household that has it. And I say this because if you get into this loan because you want to be mortgage-free or debt-free, that's great. This loan is going to help get you there, and it will help you save in interest costs. However, if 5 or 6 years down the road, you decide, I think I want to invest in this business. I think I want to purchase another property. You have the ability to. It's where that cheesy line where you get to become the bank of you comes from, because you get to make those decisions. Do you want to access your equity to go purchase another property? Okay, you have that choice. So the all-in-one loan can very much change and adapt to the family and household that has it. We also have an interactive comparison simulator. So if you have not gone through this with your loan officer yet, I highly recommend that you do. It is a simulator where you mathematically input the information on the comparison loan, so the loan that you would get if it wasn't the AIO. You would put in information on what you would deposit, what your spending habits are, and then you get to the results page. Now, we return results based on information provided. So remember, good data in equals good data out. Bad data in equals bad data out. You want to make sure that you're answering the questions as accurately as possible so we can return results that are going to be accurate for your scenario. And we do have some defaults behind the scenes that might not be counterintuitive. So I absolutely recommend that you have your loan officer with you, whether that's to go through your scenario or to go through a sample scenario, just so that you can see how to use the simulator correctly. So at this time, I can open it up to questions if there are any. If there are no questions, that's also okay, because we did go over a lot of information in a short amount of time. But I do want to thank you all for your time and your attention this afternoon. It's been great. I hope you learned something. And if there's ever anything that we can do to help in your understanding of the product, by all means, please feel free to reach out.